My name is Melanie Pirro. I'm the Executive Director of ADS Dental Transitions. I'll be facilitating this webinar today. There'll be questions that you can put in chat, and I'll monitor those for the panelists to answer. And there'll also be some time for questions at the end. We're glad you're here, and I'm going to send it off now to Phil Hoover.
Thanks, Melanie. My name's Phil Hoover. I'll be navigating this webinar as we go. I am a broker agent at Western Practice Sales and a dental finance consultant. The majority of my career has been spent in the dental field. And today on our panel, we have Tim Giroux, who is the owner and broker of Western Practice Sales. Tim, you want to introduce yourself?
Hey, Tim Giroux, graduated Creighton 1983, practiced for almost 20 years, and then kind of fell into owning Western Practice Sales in about 2001. So we've been doing this for almost 25 years now. So
thanks, Tim. And also on our panel today, we have Hayden Warren of Thomas Dahl, the Earned Wealth Group. And Hayden, if you want to introduce yourself.
Sure thing, Phil. So just to put a little spin on Tim's introduction in Western Practice Sales, I put on a necktie in 1980, started working with doctors. I was arranging loans back when money was tight and it was hard to get loans. But I met a nice fellow by the name of Bob Repka and his buddy John Noble, who were two of the original guys at Western Practice Sales. And so I've known you guys longer than you've been there.
Yeah.
I'm a CPA and financial advisor for dentists. I work here with Thomas Dahl. Thomas Dahl has been acquired recently by a firm called Earned Wealth, and we are excited about that. Earned was interested in us because of our CPA firm and our payroll service and obviously wealth management business and pension plan administration. So we're in a new chapter of our lives and looking forward to things going forward.
Thanks, Hayden. One thing that I did not mention is that we are a member of the ADS American Dental Sales Group, which is a nationally recognized group of brokers across the nation that we all work together and compare notes and look at case studies and things together that allow us to continue to grow and learn as we go through this brokerage business together and the dental transition business together. Same thing with the ADCPA and Hayden's group. They are a nationally recognized endorsed company as well that has a footprint in all 50 states across the United States in terms of their CPA and financial planning group. So we have a lot of knowledge here today, and questions, feel free to bring them in as they come. And if they are on topic, when we're on the topic, we'll try to answer them immediately. If not, we'll hold back towards the end of the presentation and we will discuss what we can, time permitting. So today we're going to talk about teeth. And these are not the teeth that you work on in the dental chair, but really the teeth that you work on throughout your professional career. And your teeth are your transition, evaluation, equity, taxes, and home or health. We can all agree that your teeth, when they are not in alignment, problems do occur. Problems such as pain, discomfort, anxiety, lack of self-confidence, sleep disorders, and all these problems tend to worsen over time. And our teeth are currently the core of our personal health and all of our day-to-day operations. So we got to be very aware of them. So in this discussion is a very high-level introduction to all these topics: the transition, evaluation, equity, taxes, home or health. And we will take questions as they come in. So we want to jump right into it, and we want to start talking about transitions and what that means today in our marketplace. First, we have to ask, really, what is a transition plan? Have you thought of one? Have you spoken to somebody about it? Have you seen your peers go through it? And what does a transition mean to you personally? Now, transitioning means moving into the next phase of your professional and personal life. If you've planned accordingly, this is a very exciting time. For others that have not planned, it can lead to anxiety, nervousness, pain, lacking confidence. And to get with your professionals, dental professionals that are in your book, that planning helps alleviate the pain in those issues. And, a few of these questions that you need to sit down and ask yourself when you're talking about transition is, how do I want to transition? What does it mean to me? Is it maybe selling my practice outright? Maybe it is bringing a partner. Do I have a future heir that may want to take over my practice? Is there somebody in my family, somebody in dental school that I've mentored? All those questions come into the transition. Maybe I want to keep working. All those questions need to be answered on the front end. And I will tell you the majority of practice transitions that this group works with are 100% buyout arrangements, meaning a doctor selling to a doctor where it's a one-on-one walk away type of a transition. You list your practice for sale on the open market and you find a suitable buyer. Then the buyer doctor takes over the practice, assumes the dentistry, assumes the clinical work, assumes the books of the business. Maybe you work back, maybe you moonlight for a while, but typically the majority of the deals that we do are a one-on-one basis with doctor to doctor sales. In this situation, there are a lot of opportunities for the selling doctor, again, to keep his hands wet and continue working dentistry, and the same opportunity presents itself to walk away completely, right? There are other types of transitions where we talk about existing associates or heir apparents. These arrangements aren't as frequent, but we do work with clients in this structure. Now, when we're looking at existing associates, maybe they've worked with you for a month, maybe a couple years, and they've expressed interest to buy. And there's a lot of times friendly relationships and friendly conversation that goes into those talks of transition and potential being the heir apparent. And they're very friendly on the front end. And it seems very clean and simple. However, those types of transactions and transitions tend to be a little bit hairier than what you think. And this is where it gets very important to talk to your transition specialist, your dental specialist in your marketplace, or us here in this panel to talk about some of those hurdles that you're going to see when approaching a potential associate. Same goes with an heir apparent, maybe a family member or a mentor, or you'd be mentored to somebody. All of those transitions potentially have issues with partial ownership, percentage ownerships, finding ways to partnerships. And I think everyone on this call that has worked with several partnerships, sometimes are the best or the worst types of transitions that we've seen. Because the partnership is very similar to a marriage. It's got to be all in. So, and in that regard, we have 100% buyouts and we have different transitions with partners or heir apparents or mentoring. Now, the one topic that I think is the biggest word in dentistry today, and I'm going to let Dr. Drew take the lead on this, but is the word of DSO, and that's the corporate sale. And I'll hand it over to Tim to elaborate on that.
Thanks, Phil. Well, actually, just for a little background, I actually sold my practice to a DSO back in 1999 before they were a hot topic. They were just starting to get going as far as that investment area, and it was a publicly traded company. So I'm kind of pretty familiar with this space. And then for a while there, it was like the wild, wild west. We were doing Nevada and Arizona also, and those states were a lot more active in the DSO space than California, and still are. California is still not one of the active DSO spaces, a lot because our margins just aren't as good as some of the other parts of the country. But what people don't understand on the DSOs, they're kind of coming into, they're all sounding very similar. Obviously, Heartland was one of the biggest ones, and they had 2-year holdbacks. They would hold back 20% of the purchase price and 10% each year if you hit the number. Most of the new DSOs are having you stay on for 3 to 5 years. Most of them want you to stay for 5. And some of them are different. They'll give you a promissory note that does pay again on the calendar year and depending on performance. So we've sold a couple DSO practices this past year, and our advice on this is most of the time there's a thing called EBITDA. We'll get into that, and of course a lot of you know probably already, and Hayden can chime in on this later. But it's it's an accounting term, is earnings before interest, taxes, depreciation, amortization. So that term to me is used in my humble opinion, should only be used on a situation for these big practices that, because what we do a different evaluation. The DSO space is pretty much limited now to practices over 1 million, and maybe some of them are saying minimum of 1.2 million. Some want at least 6 operatories or more. So a lot of people don't understand that, you have to have a pretty good sized practice before you even qualify for this discussion. And I know most of you are getting postcards in the mail and, promises that you're going to have this unbelievable valuation and paid to you. But for the most part, the DSOs are going to pay you half of your practice valuation up front based on this EBITDA number. Well, we did a couple practices this past year where the EBITDA multiple, believe it or not, worked out to almost twice as much as what we could have sold it on the open market. And there's some different reasons for that we can get into later, but they were bigger practices, a lot of hygiene and just very active. And so, and the issue with that is, if we just want to keep it down for easy math, say on $1 million practice here in California, we like to see about $350,000 of profit go to the doctor. Well, that to me is profit. That's not real EBITDA number. And the issue with that is so if the doctor works back for that same the company that buys him out and he keeps his numbers defined to get he's actually only producing 750 or so, or maybe 800 to get to, that $1 million collections, and he's going to be paid 30% of that. So he's going to get paid maybe 240,000 or so to be an associate following, every year for the 5 years to qualify. Well, now he's taking home 240, and he would have been taking home, let's say 350 if he was an owner. So there's that little piece of the pie that, that's why you ask your advisors, that whether it's, Western Practice Sales and Hayden, your accountant, we got to crunch these numbers for you so you know exactly what you're getting into, because that you're going to be working as an associate. You're going to be working for the man, essentially. You're going to be working for a bunch of suits that want to, increase the bottom line, increase the production, change the way you, probably practice, even though they tell you they're just going to make your life easier. That's not always the case. I mean, sometimes it is helpful, but other times it's kind of a bigger mess. And I did the same thing. I worked back for 1.5 years. I enjoyed my dentistry, but yeah, I took home about half of what I would if I just would have kept my practice. But it was worth it because I was making a transition to California. So that's the whole point. Everybody has a different set of circumstances. Most of the guys that call us want to retire soon. And so they really don't have 2 years to 5 years to give to the DSO, even if their EBITDA number works out. So the point with that EBITDA, the true EBITDA is on this practice that we were talking about, the $1 million practice that shows $350,000 of profit cash flow. They got to take away the $240,000 or $250,000 worth of salary that the doctor made. So the EBITDA number on that $1 million practice might be $100,000. Maybe it's $120,000. And these DSOs they'll pay up to 6 times EBITDA, but then they're going to only pay you half of that. So if you do the math here, we're talking a practice that's $1 million. Maybe it'll sell for 600 or 700 based on the EBITDA number here. Well, that's what I would sell it for straight cash in a normal situation anyway. So my advice a lot, and we'll help crunch those numbers through. And the whole point is we got to run these production collection reports. A lot of people don't know how to look at that like I do as a dentist, and, Phil, and that's been doing this, that, you got to look at your dental production, and that may not include x-rays. It's not going to include adjunctive services. It's not going to include a $50 charge for somebody that missed their appointment. So you got to dial down into what your production really would be that you're going to get paid as an associate moving forward. And that's how we really find your EBITDA. That's what they're looking at. And like I said, on occasion, we have a practice that EBITDA, for whatever reason, is above the normal standards. And it might make sense for them to go ahead, in my opinion, if they're getting 80 to 90% of that purchase price up front anyway. If they leave in a year or two, who cares? There's still money ahead, and basically, or at least break even, and they gave it a try. But otherwise, you're married to that company under their terms. And so the thing is that, most of these companies are, they're hitting you directly. They really don't want, us to be involved. I mean, I think sometimes, they paint a pretty rosy picture, and you really need to have your accountant sit down, and you're going to need, to work together to find out what your take home is going to be as a 30% of collection, associate after the fact. I mean, what are you really going to give up in the years following to see if this really is a good deal for you? And the other thing is too, is that, you know, I've been negotiating with these guys. I negotiated my own sale 20 years ago. I mean, we kind of know the space. They're all a little different. And I think sometimes they negotiate better when they have, a broker representative that knows what they're doing to help you through this process. And so yeah, I guess I wouldn't fly solo, on these situations. There are a lot of things to look at if the DSO space makes sense to you. And but again, you have to realize that it's not your private practice anymore. You're working, essentially you're working for the man, which may be fine. I did for a year and a half. It was a great situation for me, but like again, we all have a different path of where we're trying to go with that. And by the way, I insisted that they pay me 100% cash, so I didn't take their stock. And so you can still negotiate some of those things. Some of these DSOs have hard and fast rules. Everybody has to be the same. Others are a little more negotiable on these issues. And so that's, again, it's good to have, your team and somebody to guide you through these things as far as doing that. So I guess that would be the biggest takeaway I'd say, is that, they're here to stay. It's not, they're bigger in other states. They're going to be in California, but it's not just about cash flow. This EBITDA number is a different number that really has to be dove into based on your production of what you only do in dentistry, because that's what your salary is going to be. And that's how they formulate the EBITDA to give you that multiple. So
Thanks, Tim. Appreciate it, man. Hayden, I'm going to let you chime on this and a little bit further downstream. I'm going to get through this evaluation part, then I'll let you chime in on the DSO EBITDA conversation. Is that all right?
Sure.
Hey,
Perfect.
Phil, there is a question.
Oh, I didn't see it.
yeah, I saw that.
Okay, it's in the F. What about the recap event and the payout from there?
Right. So some of these companies, basically, that is some of their promise to everybody. And again, that may work out fantastic. And so the recap event is these companies basically go for their round 2 of money, which usually 3 to 4 years after they start their first round. And Hayden, you probably can chime in on this too. And that's where, so my son is actually in investment banking in LA. I mean, he's actually had some of these big deals go across his desk, and they haven't bid on any of them, basically. But the point is that there's levels of multiples of EBITDA. So, initially you might sell your practice for 4 to 6 times EBITDA, as a nice big size practice. Once they get to roughly around $30 million in EBITDA, is a bigger number. So obviously your practice might be doing an EBITDA of 300, 400. I mean, those practices that are doing 1.5 million probably have an EBITDA of somewhere around 300 to 400 of the EBITDA after they pay all the doctors. So you can do the math, how many practices you have to have at these companies are doing, and then they can go to round 2, and then they can get 11 times EBITDA, then they can go to round 3 and get up to 15 times EBITDA. So usually there's portions, on that takeout down the road that you've already sold 50% off at least on these particular ones. So this is a different type of situation, DSO, that I was speaking about earlier. So a lot of the hooks that you're seeing and the incentives that you're going to get this big arbitrage play by being part of this bigger group that's going to go sell out. So you might keep 50% at first, or 49%, then you sell another 20, 30%. The problem is on some of those, I mean, I know on one in particular, I won't name names, that their last 20% is kind of like you're off on your own. You have to find somebody that might want to buy your share of this particular practice and only own 20% of that. So you just really have to read the fine line. And so, I mean, if those things work, and I have a friend that's worked out. I know a couple of people that this has worked out fine for, and I have other friends that it's not as it worked out. They were supposed to get bought out in the second round 3-4 years ago, and they're still waiting. So again, the point is you just have to kind of know what you're getting into. That's like gravy on the cake. And one of my friends that I think is going to do fine, again, he sold his 50% out for close to what we would have basically got on the open market anyway. So if this gravy comes, or this icing on the cake comes later, fantastic. He's hit the home run. If it doesn't, he still did fine. Now, having said that, he's been working as an associate for the last 3 years too. So again, the second part of the recap event is there's 2 or 3 of them out there that is part of their promise. That sounds really intriguing. And I'm sure Hayden's been involved with a couple of those. I'd love to hear, his experience on those.
Well, my experience with DSOs is that there's good ones and then there's the other guys. And really it comes down to due diligence and looking at the business plan and all of the particulars and the team and the players and so forth. So I don't want to go too deep into DSOs, but it's just a matter of making sure who you're getting involved with.
Thanks, Hayden. Thanks, Tim. I'm going to move on to the first E in teeth that we're talking about, and today it's going to be evaluation. And this is the evaluation is both the physical and the financial stock in the practice. And I want to touch base first with the physical plant. And I had a doctor say this to me and a consultant say this to me the other day. He said, you know, when's the last time you walked through the front door and had the patient experience? And I thought that was genius. That, you know, as the doctor, you typically came in the back door, had your own separate entrance and exit, and you didn't come through the front door and to have the patient experience. So, you know, when you're looking at the evaluation of the practice, you got to look at the physical plant. You got to look around, see what you see what the patient sees. You know, are the ceilings stained? Is the carpet torn up? Is it displaced? Is equipment in the wrong place? Is the flow to the practice correct? You know, things of that nature. Is there eyesores as soon as you walk in, or the equipment that the patient originally sees as walking through the practice and being seated in their operatory? You know, all those things need to be addressed. The other piece of that as well is, you know, there's opportunity there that maybe there's time to make an investment into the physical plant of the office. You know, there are tax advantages, and Hayden will speak to this later, I think, where you can buy some equipment, you can depreciate it. If you're looking for opportunity there, that some of these individuals that are looking to buy offices today, they're not interested in 20, 25-year-old equipment. They'd like to see something, you know, that's 10, 15 years in age at the latest, you know, and they want to have digital opportunity and potential to grow within the space, the physical space, to work with the equipment that they're comfortable with. So there is some opportunity there when you're looking at the physical space. Am I saying to go out and spend a couple $100,000 on the physical office and new equipment? No, that's not what I'm saying. But I'm saying that there may be an opportunity there, both for you today to maximize your value, and potentially there's some tax savings, income savings with making a small investment in your business today for the physical plant, right? And the second piece of this is the financial evaluation. And this is where, you know, the brokers, the CPAs, such as on this call, and now you tie in the bankers into this, where they're going to evaluate the cash flow. What Tim was talking about and Hayden were talking about earlier, we're going to discover the cash flow. If you're not familiar with cash flow as a business owner, you need to get familiar with what a dental cash flow is. It's a little bit different than the drugstore, than, you know, a grocery store down the street. A dental cash flow has certain advantages and disadvantages in that profession alone. And any of these professionals, dental professionals on this call today, will be able to go through the line items and kind of tell you what a dental cash flow looks like. And we're going to look at a historical analysis for 2 to 3 years historically. And we're going to make sure that your business, in terms of an evaluation, can cash flow not only paying a doctor's wage, meaning yourself, but we're going to make sure it can cover the loan amount or the debt service that the practice is going to have to afford in order for it to sell. And that goes together in terms of finding what the full potential value is to your practice going forward. Tim touched on it earlier about $1 million practice, and the same goes with the EBITDA, goes with cash flow. When you're looking at $1 million revenue type of practice, on average across the nation, $1 million practice should cash flow somewhere between $300,000 and $400,000. That is what we consider benefit to owner, right? The $300,000 to $400,000 benefit to owner, and that's on average. And the same $1 million revenue office, some of them cash flow only $200,000, and some others at $600,000. So you've got to really know where your numbers are. And a lot of people, if you're not planning accordingly and talking to your dental professionals, a lot of people come to the time where it's time to sell or time to transition, and they look at their numbers and they haven't talked about it in 3 to 5 years. That could be a real problem. It could be a huge problem. That's where the anxiety steps in. That's where the sleepless nights step in. That's the stuff that we need to avoid, and that's why we need to check our teeth. You know, we got to check it regularly. I go to the dentist 3 times a year. You know what? It's probably not a bad idea to see your professionals 3 times a year. It's only going to help in the long run, and it doesn't hurt anything. So that's a big piece to the value, both financial and the physical plan. Gentlemen, anything you'd like to add to that?
Well, I think the walking through the front door of the office is huge. I've been espousing that for decades, and it's really, really important to see what the patients see. Phil, you talked about looking at the physical plant. An ideal sort of situation that I had years ago with a client, we had about 4 years of runway before he was going to sell the practice. And the physical plant needed some work. And they took care of that. But one of the things that was really, really important is that, you know, he had 4 operatories and they were up a flight of stairs. And there was a storage room on the ground floor. So before the sale, we got the supply people involved and created an ADA accessible operatory in that empty storage space. It really enhanced the value of the practice.
Thanks.
The thing I would add, Phil, is that one of our brokers in the state won't even take on practices that don't collect at least 600,000 now, and so we are at a different part of this. I mean, back in 15 years ago, the smaller practices would fly off the shelf. Now it's just the opposite. It's a lot of it's because these poor kids are coming out of school 500,000 plus in debt. They can't afford to buy a small practice. I mean, if they want to live in California in some of these areas, I mean, they have to have 250, 300,000 worth of the cash flow before the EBITDA, before the debt service and amortization. So basically, everybody has to keep that in mind, So some of these, sometimes people take away from these seminars and they'll go spend all that money to do that. Well, they have a practice that's probably more of a merger opportunity to go month to month lease until they find somebody that might buy the practice. Now, I don't believe mergers should go for less money, because to me, mergers are double the return on investment if it's done properly. I mean, that means, you pretty much have as much, many of the patients transfer to the new practice as you would from a regular transition. So there's a lot of, you have to have a Pied Piper. There has to be maybe the dentist works back for a little bit, maybe a hygienist front office. But the point is, those things are fantastic for people to grow their practices. And for somebody that's wanting to take the next level, they've got 8 operatories. They want to get into this EBITDA game with a DSO or whatever the case is. They should be looking at some of these small practices to bring that patient base into their own space. I mean, those would be great opportunities. So for somebody to go out and drop a bunch of money, if they're only doing 300 or 400 a year, 500, that would not make any sense. So most of the time I tell people, do the obvious things. Like you said, take care, have that front door experience, but don't spend. People have different, opinions on what type of x-rays, what kind of chairs they want. So I wouldn't spend the money in the dental equipment, but boy, you can certainly try to pretend, go look at all the piles of junk you have in the corners and your closets, and just clean all that stuff out, before you, but again, I think there are places that you wouldn't want to invest those extra sums if your practice is not going to be, it's not going to be sellable anyway.
Thanks, Tim. I'm going to move on to the next letter here. We have is E, is the equity of our dental practice. What really is equity? The equity that you've created in your office. The equity, we refer to this as goodwill. We refer to all the blood, sweat, and tears you've put in for the years and years that you've owned the business. And what is goodwill? It's really what it is. It's the patient base and their frequency and loyalty to visiting the practice. And when you look at the goodwill as a whole, you got to look at not only the numbers of how many people are going through in terms of understanding your recall and your pro fees and things like that, but you also need to dig a little bit deeper and look at your insurances, look at the fees that you're getting billed or billing out, and what you're collecting on those fees. You got to look at the treatment plans and your acceptance rates. You got to look at the new patient flow. How many patients are coming in? How many patients haven't you seen in a while? You got to look at your collection rates. And, are things pushing out? You're making a lot of handshake deals, pushing out to 60, 90 days. Are you losing money there? You got to look at your referring network and your marketing as well. Just you need to understand where that value has been created, because your next potential buyer or next potential doctor in that office is going to be looking for these things. And this is where they're going to judge our evaluation on what equity is left in the business. They're going to want to know that there's work to do on day one. And, working with, Tim and I and Hayden and all the peers that we can refer you to, we just want to make sure that when we position the practice, it's in the best light that a new transitioning doctor into the space is going to be able, one, to pay their personal bills, and two, pay the business bills and keep this thing afloat. So as Tim has mentioned a few times, is that, these bigger practices are getting the eye of the beholder because they need the additional cash flow to make things work. And that being said, understanding what the equity is and the drivers that are building that value internally with your practice is what makes it sellable. And that's why it's extremely important to understand, goodwill, where it's coming from, the patients that you're seeing, and how many new patients and how much of the case studies or case work that is completed. So on that, Tim or Hayden, would you like to add anything to that?
Well, my same client with the ADA operatory knew that they could do some enhancing within the practice, and we looked at their hygiene department in particular. So we saw an opportunity there, brought in a hygiene coach, revenues went way up. That not only enhanced the value of the practice, but it gave the buyer, some good framework and some good a good head start when he bought the practice to come in and just have a well operating machine. Really adds to the value.
I would say, I think I wrote this book about 7 years ago, but most of it's pretty applicable. If people want to give us their email addresses, I think Melanie can take care of that. We can certainly get the digital version, but there's a few things that have changed since then, but for the most part, yeah, that's the thing. The book was like, what you should start thinking about 10 years out. And that's kind of what we're trying to do in the seminar. You need to start thinking of this stuff early. A lot of times that people call us, they're like, they want to retire in 3 months, or they want to retire by January 1. I had a couple calls last month. I'm thinking, well, that's not going to happen, and interestingly enough, I'd say most of them haven't even talked to their accountant or their financial advisors. And you're kind of thinking like, you need to sit down with your accountant and financial advisors and make the plan. And yeah, maybe, because the reality of it is your dental practice, sale is probably not going to be the biggest portion of your financial plan anyway. You're only going to get about 2 years worth of what you normally take home. And so you could even do the math there. You could work an extra 2 years and you're in the same boat financially. Of course, you had to work hard for it. But the point is that, but you should be planning this in the future, and talking to people that know, so you're not spending money unwisely, thinking you have to upgrade things, but also if you give yourself 5 years, you can do things like Hayden said, and you can increase your production, you increase your hygiene program. You're going to get paid, let's say roughly 70 cents on the dollar for every extra dollar you actually increase your revenues for. So think about that. That's why I tell people to make their deposits, in December and before the year they're thinking of selling, and finish off the year strong. Take your vacation in January, because the point is you're going to get 70 cents on the dollar extra for every dollar you deposited. So there is some smart planning you should be doing, at least 5 years out. And some of that may be you have plenty of gas in the tank. Well, maybe there's some things you can do to increase your revenues. And obviously that's, every dollar you increase, it's an extra 70 cents that you're going to get paid.
Tim, thank you. And that's exactly where I wanted to go with this last comment here is, when you look at yourself and you look at the financial collections production that you're currently doing in your office, and it's not where you want it to be, do you have time on your side to either ramp it up or keep it steady for the period of time that it takes to sell? If it's not where you want to be, and this is a larger piece of your financial picture moving forward, potentially onto retirement, do you have the time? Do you have the energy? Do you have the health to do it? And that's where you do need to start planning 10 years in advance so you can get the practice to where you want to be. It's never too early, but unfortunately, it can be too late. You need to start early. And this is going to lead into the next one is taxes. And Hayden, I'm going to let you take the lead on this, but this is a large capital event. Tim, you brought it up, and I'm going to bring it to Hayden. It's a large capital event. There's going to be a check deposited into your checking account for $500,000, $1 million. What do you do with that money to keep it away from the tax man? Hayden, give us some advice on that.
Well, so I think the theme has been plan ahead. We have to look at our financial plan and make sure client is financially able to sell their practice, or if it's too soon. As far as taxes are concerned, you talked about goodwill and the physical plant. They're taxed differently. Goodwill is a capital asset. A physical plant, you have to have this pesky depreciation recapture, which is taxed at pretty high tax rates. So you have to study the tax bill, make sure you're clear on what it is you're going to net out of the sale. And every sale is going to be different because each seller's balance sheet has different assets on it and different treatment of how things were deducted in the past. So it's really important to do the tax planning ahead. As far as mitigating a tax bill, I can think of a couple of tools. We like to have our clients establish a non-retirement brokerage account, and it's a separately managed account in which we're able to harvest capital losses over a period of time. It's a pretty unique tool. It's something that was until recently really only available to super high net worth people, because the companies that set them up and run them, these separately managed accounts, had super high minimums. But we can take a client, put 500,000 or $1 million into a brokerage account and harvest tax losses over time. Capital losses accumulate. You don't get to use them every year except for about $3,000 worth. So if you're planning ahead, you've got 5 years or so, and you can accumulate a couple $100,000 of capital losses in an account. That's going to offset the gain on the sale of the goodwill. Alternatively, or in addition to, we have a lot of clients who will set up a defined benefit retirement plan or a cash balance plan. And these are a little tricky. They require the services of an actuary, but in essence, you can set up a defined benefit plan to run alongside your 401k profit sharing plan and structure it in such a way that in the year of the sale, you can put an enormous amount of money into that retirement plan and you get a big fat tax deduction for doing that. An example I have is a client who sold her practice for $3 million about 5 years ago. And we set up a defined benefit plan. She put $700,000 into the plan. Half of that saved her tax dollars. So a couple really good tools, as well as just planning ahead, which is really, really important.
Hey, Hayden, I had a couple questions that came to me in the last week, and some transactions now that we're getting close to the end of the year. They're asking about ordinary income. Should I take it this year? Should I take it next year? Can I put this money, can I take it in December, put it into January, receive it in January? How does that affect my taxes? And then on the side note, is there a way where I can potentially roll this large lump sum into a trust or something where, it's passed down, where maybe I can avoid it altogether?
So if you're talking about structuring a sale in December or January, if it's close to the end of the year, January is going to be better because in the ensuing year, you won't have a whole year of ordinary income on top of the sale. But oftentimes the buyer has other plans, and so you have to negotiate when the deal is going to close. But typically, if it's close to the end of the year, we'd like to see it in the following year. It just gives us that many more months for planning ahead. I have heard of wacky trusts and escrows and things like that to postpone the gain on the sale of a practice. No, it's not going to happen. Forget about it. The only way to defer the gain on the sale of the practice is to receive your payments for the sale of the practice over time in an installment sale. An installment sale lets you recognize your income on capital gain over a period of years. The ordinary income piece, which is the sale of all the tangible assets, that's taxed in year 1. Frankly, capital gains rates are low enough, I'd rather take the money and run rather than structure it over time just because. And that way you're not having the risk of getting paid over time by someone who bought the practice that, you know, hopefully they do great, maybe they don't, and you don't get paid. That would be a problem.
Thank you. Tim, anything on this?
No, I think yeah, there were some seminars. It was a, well, it wasn't a dentist, but I mean, it was like a veterinarian that was setting up these trusts that supposedly, and I probably talked to several CPAs, and the whole point was that, you know, they acted like if you have control, if you have access to that funds, it's you can't shield it, is the whole point. And so their whole premise was based on inaccuracies, and that was that, you know, so that doesn't work, and that's the whole point. I mean, in the installment sale, you don't have access to those funds. You're relying on somebody to pay you, and you can't just put this money in a trust and pretend you don't have access to it. So it's going to get taxed.
Thank you. All right, for then our last letter here is the final H in teeth, and that is what I call your home, your health, you know, your reality is really what it is. And I think this is maybe the most important, maybe the hardest one to digest. You know, if you're looking at retirement, you know, it's kind of hard to swallow. Is my career coming to an end as a dentist? You know, can I physically do the dentistry? Can I go to work every day? I mean, that's a hard pill to swallow. You really got to look yourself in the mirror and be honest with yourself. You know, have you spoken to family, to friends, you know, your partners? You know, where are you with that mentally? You know, do people know your timelines? Do you have goals? You know, all of this stuff, the simple conversations that these seem like they are, this is the biggest hurdle that we all run into. And a lot of the times it is too late in the game to have a conversation and get it every single way in terms of the value you want in your practice, the lifestyle you want thereafter. It just, if you don't plan accordingly, you can't have it all. So we've got to make sure that you stay on plan. You have goals written down, spoken to your spouse or your partners, to your family, your friends, talk to your peers. You know, you got to make sure that you have, you know, at the time of retirement or the next phase of your life, you know, make sure you have plans of adventures or hobbies or travel, kids, grandkids, whatever it may be. But, you know, these conversations need to happen. And health, we can go on health all day. We all have a story about health, whether it's in dentistry or not. We all have a family member somewhere downstream or with us currently that, you know, this is a topic, whether you're 25 or 85, you know, it doesn't matter. You got to prepare for yourself for that at all costs. And when it's too late, it's too late. And, you know, at that point in time, you know, all of us on the panel today, we have done the fire sale. And it's the oh crap moment, and you know, all hands on deck, and it's not comfortable for anybody, and you do not want to put yourself in that position because everyone is going to get hurt. Feelings are going to get hurt, pocketbooks potentially going to get hurt, and unfortunately that's just the way it is, or you have nothing, right? So you got to have that preparation when it comes to your house and to your health. And you know, one of the big pushbacks, and I want Tim and Hayden to talk on this, is a lot of the doctors ask about what about my patients and what about my staff? And my instant response to what about my patients is, why don't you cancel your PPO and go fee for service and see what happens? Let's see where your patients go. Let's see how loyal they really are. You want to do that? Let's increase your crown to $2,200. Let's see how loyal people are. And I'm not saying that they're all going to go away, but what I'm saying is that the loyalty is to you, and I'm not discounting that. But the reality of it is, people aren't as loyal as we think they are. And they come to see you, and they love seeing you. But they will love Dr. X just as much as long as things don't change, right? So, you know, it's making sure that the right pieces are in place for this transition. And if they are, these are seamless. They are seamless. 99% of these are flawless, right? That's why there's so many banks involved with these transitions and wanting to finance them, is because they work. They work 99% of the time. And then the next question is the same thing with staff. And you know, what about my staff? What am I going to do with my staff? Well, you know, staff are loyal to some sort, but if Dr. X down the street was going to give him an extra week of vacation and $2 an hour, Dr. X might have something to say, whether you're there or not as the managing doctor. The loyalty level in terms of the staff and patients, yes, they are there. But the reality of it is that the goodwill in this practice is you working the practice, the patient base, the historical revenues that you have shown. And as long as you plan accordingly and through your transition, through your teeth, right? And you keep your teeth clean, this will work 99% of the time. In that regard, I do want to open it up to Tim. I know we're cutting into our time, but I want to open up to Tim and Hayden just to share an example, if possible, a short example on what I'm talking about of maybe it was too late, maybe they didn't have the ducks in a row, good and bad, good or bad.
Well, fire sales, right? They happen. People have disabilities, people die. I remember a periodontist client about 15 years ago who died in his office. His wife was the office manager, a very strong person, but he had a good team. I was proud to be on the team. The attorney understood dental. The practice got sold in short order, and for good value. Around the same time, really ironically, and this is God's truth, the same year, another periodontist with a premier practice like my clients died. And a year later, I was listening to tales about, the people buying the practice and, oh, well, I don't know if I like this hygienist and that. They basically got zero value for their practice because they didn't have a good team and they weren't prepared for a fire sale.
We had a question there about the broker fee for nationwide or whatever. I mean, most of the time, in ADS, like I said, we're nationwide. It's standards 10%. Everybody, a lot of people go down to 8%. Of course, it depends on the location and the interest we think we'll get, how much time and effort we think we're going to spend, but most of them start at 10 and go down from there. And of course, the larger the practice, the more room there is to negotiate. So that's something you can always negotiate with your broker and see where they want to go with that. I don't think just like dentistry, you don't want to race to the bottom. I mean, you're trying to pick your team that knows what they're doing, has the most experience, can give you the most accessibility to the most amount of buyers, because that's what hopefully generates a better fit and a better price. And again, we try our best to do that. We can't guarantee that's going to be the case every time, but that's why you kind of go with a broker that has more accessibility to the marketplace and the buyers that are out there. Again, there's no guarantees in this game anymore, but that's again, you can negotiate that price, but I wouldn't chase the bottom. I would go with a broker that knows what they're doing and has a lot of connections with buyers out there.
And the right buyers, Tim, the right buyers.
And that's a tough one, of course, and we can be as patient as you can, but that's why you want to plan ahead. It may take longer and you're not forced to sell your practice to anybody that makes an offer. You can choose your successor. But that sometimes it takes more time. So you just have to be, understanding that might take a little more time to find that, that person that you really like. Sometimes you find them right away and you think it went too fast. We have one of those going on right now. And, the client doesn't realize that, boy, he should be thanking God and put a little extra money in the church bucket. But it went so fast that he thought it was, went too fast. So it's just kind of funny how this works sometimes. But it's kind of like the doctor that did the crown in 20 minutes as compared to an hour and a half and taking 4 impressions. I mean, the patient that gets up after 20 minutes goes, wow, I still got to pay $1,400 for that. My last one took 2.5 hours. Well, wouldn't you rather have one take 20 minutes instead of 2.5 hours? So, but anyway, that's as far as I think it helps to have, like Hayden said, put together your team and get that done in advance. And sometimes things happen, and if you had your team in advance, that your spouse or surviving spouse or son, if there's an issue, that they know who to contact, and that's very helpful.
I'll make one other comment about broker fees. I'm not a broker. I was in a prior life, but whenever I am working with a dentist buying a practice and there's no broker involved, my antenna go up and my skepticism gets multiplied by 10. Because oftentimes there are issues with the practice that maybe one or two of the brokers that looked at it didn't like. So I strongly urge folks to use a practice broker. It lends a lot of credibility to the practice and keeps the costs on the buyer side way down, because it's just that much less scrutiny that I have to put a practice through when there's a reputable broker involved.
Thanks, Hayden. Tim or Hayden, closing remarks?
Yeah,
Plan ahead.
ran out of time, so if anybody wants to type in a question, do it now.
Yep.
Good deal.
On that
Thank-
regard, Hayden, I
Here's another
appreciate your
one.
time. Thank you greatly. Tim, I appreciate your time. Thank you
Wait,
greatly.
guys, there's two more. Do you mind staying
Oh,
on?
go ahead.
Okay, there's two. But what about the recap event and the payout from there? And then when does it make sense to pay 100% of collections?
I think we answered the recap event already. That was the DSO discussion.
Okay.
And as far as paying 100% of collections, you know, that's what the market is. If we have some of those, Cupertino near Google or whatever the case is, that an Apple, that those practices might go for 100% of gross, but usually they cash flow. The bank's going to want to support that, and if they don't, then the buyer has to be a little stronger and see the value in paying that. But it's, you know, again, that's the houses in you know, in San Francisco are a lot more expensive than the houses where I live. I mean, it's a function of the market.
Okay.
Okay. Well, everyone, I really thank you for your time today. Thank you for logging in. I know Melanie is going to trade off some email addresses and things. We're going to send out some follow-up content on this, and follow-up questions. Feel free to email or call us independently. All we all ask is, call with questions, email with questions, and plan ahead. As Hayden said, it's never too early to plan. No, never too early to start. So in that regard, thank you again for your time, and take care.
Thanks, everybody.
Bye, everyone. Thank you.